to NeuralTarot. Today, we're diving into something fascinating: market bubbles. We're going to pull back the curtain and really look at the hidden psychological patterns that make them happen. So, why do markets sometimes go completely off the rails, rising far beyond what any logic would justify? You see it happen, right? Assets suddenly soar, everyone gets excited, and then they crash. What causes this collective break from reality? Well, to figure that out, we actually have to start with how markets are supposed to work in a perfect world. Right. So before we can get into the messy, irrational side of things, we have to look at the rational side. The traditional view, sees the market as this perfectly logical place, a world where everything comes down to cold, hard numbers. And the main tool in this rational world, it's something called fundamental analysis. The best way to think about it is like detective work. Seriously. An investor digs through financial statements, checks on a company's health, looks at the competition, all of it, just to find one single crucial number. And that number is what we call intrinsic value. The idea here is that in this perfectly rational world, every single company has a correct price. The market might get it wrong for a little while, sure, but the belief is that eventually the true value will always win out. Okay, so that's a really clean, logical model, right? But it has one huge blind spot. It leaves out the most unpredictable variable imaginable: us, people. And that's where human psychology crashes the party and starts to bend all those neat and tidy numbers. This is a great way to think about it. It's a classic analogy that really gets to the core of this whole thing. On one hand, the market can be a weighing machine, carefully measuring a company's real substance, its fundamentals. But in the short run, it's often more like a voting machine, basically a popularity contest, completely driven by feelings like fear and greed. And what sways the votes in that popularity contest? Well, it's these really powerful psychological biases that we all have. Things like herd behavior, just following the crowd, or loss aversion, that feeling where the pain of losing $100 is way worse than the pleasure of gaining 100. We also get overconfident, thinking we know more than we do. And we do this thing called extrapolation, where we just assume that whatever's been happening lately will just keep happening forever. These are the invisible forces that are constantly pulling us away from making purely rational choices. Now, here's where it gets really interesting. When these little individual biases all start to sync up across millions and millions of people at the same time, that's when you get something much bigger. A powerful collective phenomenon we call a speculative bubble. So let's break down how this emotional contagion really takes hold. You see, bubbles don't just pop up out of thin air. They almost always start with a little seed of real, genuine optimism. Maybe it's a new technology or a new market opportunity. Then, as prices start to climb, that optimism turns into excitement. People start to get that fear of missing out, or FOMO. And this is the turning point, where the whole story people are telling themselves begins to shift. It leads right into that final stage, pure euphoria. And that's when prices completely disconnect from any sense of reality. And this is the really dangerous circular logic of a bubble. The rising price itself becomes the justification for buying. Think about that. People stop investing based on actual value. They're just speculating. They're betting that there will always be someone else down the line willing to pay an even higher price. It's this self-reinforcing feedback loop, and it just gets stronger and stronger with every single person who jumps in. And what's at the very center of that feedback loop? You could argue it's the most powerful force in any market, our deep, deep instinct to just follow the herd. And look, this isn't just some vague feeling we're talking about. You can actually see it in the data. This table here shows a measure of how independently investors are behaving. So during normal pre-crisis times, the number is higher. People are thinking for themselves, making their own decisions. But look what happens during a crisis or a bubble. That number drops a lot. It means everyone is starting to move together in the same direction. The herd is officially in charge. And that's really the key takeaway here. A price on a chart, it isn't just an abstract data point. It's a living, breathing reflection of our collective emotions. It's all of our hopes, our fears, and our greed all playing out in real time on a massive global scale. So when you take a step back and zoom out from the day-to-day noise, you start to see something incredible. These moments of collective emotion, they're not just random events. They're actually part of a much larger, often unseen pattern. I mean, market bubbles aren't just one-off financial events. Sure, they might feel totally unique while you're in the middle of one, defined by some brand new technology or a new kind of asset. But when you look closer, what you're really seeing are repeating patterns of collective human behavior. The technology changes, the assets change, but the core human psychology that drives the whole thing, it stays remarkably, and I mean remarkably, consistent. It's that old saying, right? History tends to repeat itself. And it's really the core idea behind behavioral finance. The exact same patterns of optimism, excitement, and then euphoria have echoed through time across generations of investors. We're talking from tulip bulbs way back in the 17th century all the way to the dot-com boom and whatever comes next. So, what's the big takeaway from all this? It's that the market isn't just one thing. It's really a dual system. Yes, it's driven by that rational world of numbers and spreadsheets, but it is just as powerfully shaped by these invisible currents of human psychology and what we all collectively decide to believe. In truly understanding these behavioral patterns, that's the key to really getting a handle on the markets. Thanks so much for joining us. Make sure to subscribe to NeuralTarot as we continue to decode the unseen patterns that are shaping our world.